Welcome to Finantax Clips, your hub for insightful financial knowledge. Today, we're going to unravel the wealth-building secrets of the Forbes 400, as shared by financial coach Todd Tressitter. Todd, who used these principles to retire at the tender age of 35, penned an enlightening article on how mathematical, provable concepts can secure your financial future. Throughout our discussion, we'll explore the crucial role of mathematical concepts in wealth generation and the potent power of compound interest. We'll understand why risk management is a pillar of long-term financial success and learn about the judicious use of leverage. And last but not least, we'll delve into diversification, a key strategy to manage risk and foster long-term wealth. These insights are not just for the financial enthusiast, but for anyone who aspires to build significant wealth and secure their financial future. So buckle up as we delve into the wealth-building secrets of the Forbes 400. We start our journey with the fundamental building blocks of wealth creation, mathematical concepts. It may seem daunting at first, but let's break it down. Understanding mathematical principles is akin to having a roadmap for your financial journey. This roadmap can guide us towards making informed decisions that will help us achieve our financial goals. Imagine mathematics as the underlying fabric of wealth creation. It's not about complex equations or intimidating formulas, but rather it's about understanding simple concepts like interest rates, percentages, and the exponential power of growth. These principles are the guiding lights in the vast universe of financial decision-making. Take, for instance, the concept of interest. It's a simple mathematical principle, but has profound implications for wealth creation. Whether you're saving, investing, or borrowing, the rate of interest comes into play, influencing the outcome of your financial decisions. Then there's the concept of percentages. When we talk about investment returns, tax rates, or inflation, we're essentially dealing with percentages. Understanding how these percentages work can help you assess the potential gains or losses of an investment, the impact of taxes on your income, or how inflation can erode your purchasing power. One of the most empowering mathematical principles is the concept of exponential growth. It's the magic behind the power of compound interest, and the reason why starting to invest early can make a huge difference in the long run. But it's not just about understanding these principles, it's about using them to your advantage. It's about making them work for you. For example, knowing how compound interest works can help you appreciate the benefits of long-term investing. Understanding percentages can help you make better decisions about where to invest or how to manage your taxes. In essence, a solid grasp of mathematical concepts paves the way for sound financial decisions and ultimately, wealth accumulation. Mathematics is not just a subject in school, it's a powerful tool that, when used wisely, can help us build and protect our wealth. Next on our list is a powerful wealth-building tool, compound interest. Let's delve into the magic of compound interest, often hailed as the eighth wonder of the world by financial enthusiasts. It's a simple concept, really, but its impact is profound. Imagine you've invested a sum of money at a certain interest rate. After the first year, you earn interest on your initial investment. Now here's where the magic happens. In the second year, you earn interest not just on your initial investment, but also on the interest from the first year. This interest-earning interest phenomenon is what we call compound interest. The beauty of compound interest lies in its exponential growth. The longer your money is invested, the more time it has to grow. The interest you earn each year becomes part of your investment and earns more interest in the years to follow. This cycle continues, leading to a snowball effect where your wealth grows larger and faster as time goes on. Now you might be thinking, that sounds great, but how do I make the most of compound interest? The answer is simple. Invest wisely and let time do its thing. The power of compound interest is most evident when you invest your money over long periods. This is why starting to invest early is crucial. Even small amounts can grow into substantial wealth over time. However, remember that the rate of return on your investments also plays a significant role. Higher rates mean more interest, which compounds to increase your wealth faster. But be careful, as higher rates often come with higher risks. It's also worth noting that compound interest works both ways. It can be a boon when you're investing, but a bane when you're borrowing. When you take on debt, you pay compound interest to the lender, which can quickly add up. The power of compound interest lies in its simplicity. It's not about timing the market or finding the next big thing. It's about making consistent investments, giving them time to grow, and letting the magic of compounding do its work. With patience and smart investing, compound interest can significantly amplify your wealth. Moving forward, let's focus on a crucial aspect of long-term financial success: risk management. The journey to wealth building is not a smooth ride, but rather a rocky path filled with risks. These risks come in many forms, from fluctuations in the market, to changes in the economy, to unexpected personal events. And it's not just about the potential for monetary loss, but also the missed opportunities for gain if we're too cautious. Navigating through these risks is an art and science called risk management. It's about understanding the potential pitfalls and making informed decisions to protect and grow your wealth. It's about not putting all your eggs in one basket, but spreading them across multiple baskets, in different sectors, different geographical regions, and different asset types. Consider this. If you were to invest all your money into a single company's stock and that company goes under, you'd lose everything. But if you spread your investments across different companies, even if one company does poorly, the others might do well, balancing out the loss. Risk management is also about understanding your own risk tolerance. Everyone has a different level of comfort when it comes to taking financial risks. Some people are risk-averse, preferring safer investments with lower returns. Others are risk takers, willing to gamble on high-risk, high-return investments. Knowing your own risk tolerance can help you make investment decisions that you are comfortable with and that align with your financial goals. And finally, risk management involves regularly reviewing and adjusting your investment strategy. The financial landscape is not static. It changes constantly due to factors like economic developments, changes in market trends, and shifts in personal circumstances. Regularly reviewing your investments and making necessary adjustments ensures you stay on track towards your financial goals. Risk management, therefore, isn't just about avoiding loss, but ensuring your wealth continues to grow. It's about making informed decisions, spreading your investments, understanding your risk tolerance, and regularly reviewing your strategy. Remember, in the journey to wealth building, it's not just about the destination, but also about how safely and smartly you navigate the journey. Now onto a powerful but potentially dangerous tool for wealth creation: leverage. Leverage is essentially borrowed capital used to enhance the potential return of an investment. When used effectively, it can be a game changer for wealth creation. Imagine a scenario where you have $10,000 to invest. Instead of investing this sum directly, you use it as a down payment for a property worth $100,000, borrowing the remaining $90,000. If the property appreciates by 10% over a year, you've not made 10% on your original $10,000, but a whopping 100%. That's the power of leverage. However, it's not just sunshine and rainbows. Leverage is a double-edged sword. The same mechanics that can magnify your gains can also amplify your losses. Let's revisit our property example. Suppose instead of appreciating, the property value drops by 10%. Here, you're not just losing 10% of your initial investment, but you're in the hole for 100% of your original $10,000. Plus, you still owe the bank the $90,000 you borrowed. This is where the risk factor comes into play. Leverage can be incredibly beneficial when you're investing in assets that appreciate over time. But if you're not careful and you use leverage to invest in assets that depreciate in value, you can quickly find yourself in a financial freefall. And it's not just about choosing the right assets, it's also about managing how much leverage you take on. More leverage means potentially higher returns, but it also means higher risk. It's a delicate balancing act that requires both insight and discipline. In the end, the key to using leverage effectively lies in understanding and managing these risks. A smart investor knows not just when to leverage, but also how much to leverage and when to walk away. Leverage, when used wisely, can accelerate wealth creation. But remember, it's a double-edged sword. Lastly, we'll explore the role of diversification in managing risk and creating long-term wealth. Diversification, in simpler terms, is the practice of spreading your investments around. It's the old adage of not putting all your eggs in one basket. But in this case, the eggs are your hard-earned money, and the baskets are different investment opportunities. Diversification is more than just a financial safety net. It's a strategic move to maximize your returns and minimize potential losses. Picture your wealth as a sprawling garden. Investing all in one type of asset is like planting just one type of crop. If a disease strikes that crop, your entire garden is at risk. But if you plant a variety of crops, a disease in one area won't wipe out your entire garden. The same principle applies to your investment portfolio. If you invest solely in real estate and the property market takes a dip, your entire investment portfolio will suffer. But if your investments are diversified across real estate, stocks, bonds, and perhaps even cryptocurrency, a downturn in one area won't decimate your entire portfolio. Another advantage of diversification is that it allows you to take advantage of the cyclical nature of different asset classes. When one asset class is underperforming, another might be outperforming. By having a mix of different asset types, you can balance out the highs and lows, leading to steadier, more consistent returns. However, it's important to remember that diversification doesn't completely eliminate risk. It simply spreads it out, making it more manageable. It also doesn't guarantee profits or protect against losses in declining markets. Diversification is a strategy, not a safety net. It requires careful planning, regular assessment, and sometimes a bit of courage. In conclusion, diversification is an essential tool for managing risk and building long-term wealth. By investing in a variety of assets, you can reduce exposure to any one particular asset class and ensure that your wealth continues to grow, no matter what the market throws your way. Diversification is therefore your best shield against market volatility and a key to sustainable wealth growth. We've journeyed through the wealth-building secrets of the Forbes 400, exploring key concepts and strategies. Let's take a moment to revisit these critical insights that can guide us on our path to financial prosperity. We started with mathematical concepts, the bedrock of wealth creation. These principles are not just abstract theories, but practical tools that inform our financial decisions. By understanding these concepts, we can navigate our financial journey with more confidence and precision. Next, we delved into the power of compound interest. Often referred to as the eighth wonder of the world, compound interest is a potent tool for wealth building. By investing wisely and allowing our money to grow over time, we can generate a significant amount of wealth. Risk management also featured prominently in our discussion. In the financial world, risks are inevitable, but they can be managed. By understanding and mitigating the risks associated with different investments, we can protect and grow our wealth over the long term. We then explored the concept of leverage, a double-edged sword in the realm of finance. When used wisely, leverage can accelerate wealth creation. But if used recklessly, it can lead to significant losses. The key is to use leverage for assets that appreciate in value over time. Lastly, we highlighted the importance of diversification, a cornerstone of risk management. By spreading our investments across a variety of assets, we can reduce exposure to any one particular asset class, ensuring our wealth grows steadily and sustainably. Remember, building wealth is a marathon, not a sprint. It requires patience, discipline, and a sound understanding of these key concepts. But with these tools in our arsenal, we are well equipped to build and preserve our wealth. We hope you found this insightful. Don't forget to subscribe, share, and like Finance Clips for more financial wisdom. See you in the next clip.